Good afternoon, everyone. I hope you enjoyed the coffee break. So my name is Nairita Rakjan. I am the Business Development and Marketing Associate here at LuxFlag. On behalf of LuxFlag, I am very pleased to welcome you to the next session of the LuxFlag Sustainable Investment Week. Before we start the next sessions, I would just like to inform you about a few housekeeping rules. Please make sure to keep your mobile phones on silent mode during the session in order not to cause any disturbances. Additionally, please ensure to give your badges back when you leave the conference. Lastly, please be informed that a meeting room is available upstairs upon request. So now I'm pleased to introduce the next session for today, titled ESG in the Insurance Sector, Key Obligations and Impacts, kindly hosted by Allen and Overy. For this session, we have with us today Helena Finn, Insurance Counsel at Allen and Overy. Helena, the floor is yours.
Good afternoon, everyone, and welcome. It's really nice to see so many people here today to talk about this interesting topic and talk about insurance. This is ESG in the insurance sector is a central topic. There's been a lot of developments, so I'm happy to be able to present a few of them to you today. Just a quick presentation. My name is Helena Finn, so I'm a counsel in the insurance and reinsurance practice at Allen & Overy, Luxembourg. Our insurance practice is really dedicated to regulatory insurance questions. We are part of a more, let's say, a broader cross-practice team involving in, let's say, employment law, IPIT, etc. And we also are part of a cross-border practice within the A&O network. So that's where our let's say, our practice sits at the level of Allen & Overy. A quick introduction. So today I'll be looking at ESG from an insurance, reinsurance, and intermediary perspective. As I was saying, it's a big topic for the regulated space today, with very many recent evolutions which the sector is trying to get a grip on at the moment. I'm not going to go through all the ESG rules or give you a technical presentation because that would literally take me 4 or 5 hours. The idea is really more to look at the role of the insurance and reinsurance sector in ESG and really look at, from this role, what are the main obligations which have been imposed and are being imposed on the sector today and how we're managing to comply or maybe managing less to comply with these new obligations. So maybe just to also understand why these obligations are imposed on this sector. And when I say the insurance sector, I'm talking about the sector more broadly. So insurance, reinsurance, and intermediaries. So I'm talking about, for example, insurance brokers, insurance agents. But I'll use the term insurance sector. But really to understand why these obligations are imposed, it's quite important to take a step back and understand where this comes from and what's the objective of these new rules which have been imposed on the sector. So maybe if we start back in the Paris Agreements in 2015, their objective, of course, is to limit climate change and limit global warming to 1.5 degrees above what was pre-industrial levels. Already in this Paris Agreement, the insurance sector was mentioned expressly with 2 objectives. The first being a better insurability of climate risks, but also to addressing the protection gap, which already existed at the time in the insurance sector in relation to more climate change-related issues. When I talk about protection gap, what am I talking about? I'm talking about a certain number of actors and persons who actually do not benefit from insurance for climate-related risks. So if I look at what the EIOPA, so the insurance authority at EU level, published a paper at the beginning of this year, they were saying that actually at the EU level, only 25% of climate-related events and extreme weather events are actually insured in the EU today. So that means there's a big part of them which are not subject to insurance. So if you look, for example, at the floods which occurred in Luxembourg in 2021, there were some discussions at the time as to certain people not being insured for their homes at the time, so that was an insurance gap. If we take away from the EU and go, for example, and look at the USA, the insurance for fires in California, for example, is something which is very, very difficult to insure today because of the fact that it occurs so often. So there is a problem of a protection gap in the EU, and this was already identified back in 2015. The second text is the EU Green Deal. So this is really looking at carbon neutrality, and this led to the EU climate law, which was published shortly thereafter. Again, here the insurance sector was not mentioned expressly, but you'll see that the insurance sector will play a big role in being able to help to go towards this carbon neutrality. From these texts stem one last and, let's say, fundamental element in the insurance sector is what we call the EU Action Plan of 2018 on financing sustainable growth. Here the idea is what? Is to be able to meet these objectives, which I've just mentioned before. We need, of course, public funds to be able to fund these objectives, but public funds will not be sufficient. So we need private capital to be injected in these projects to be able to help shape a better and more sustainable future. And that's where the insurance comes into play. So really the idea is to redirect capital flows towards a more sustainable economy. And this action plan was composed of a lot of text, and I'm not going to go into detail on all of these, but a few examples are, for example, the EU taxonomy, EU green bonds, sustainable finance, and risk management rules. So all of this was packed in the EU Action Plan of 2018, which has a big impact on the insurance sector, and we're just going to see why. So what about insurers in this sector? Why are insurers, well, let's say, facing these ESG questions? So there's two main elements that I see. First of all, insurers are underwriters of risks. And they are actually currently facing the risks caused by climate change. They're facing more and more, of course, and we're all seeing it today, more and more effects of climate change. We're talking about flooding, we're talking about fires, drought, etc. And all these risks that are materializing are giving rise to an increased amount of claims under policies which are existing. This increased amounts of claims is actually giving an increase to the prices of this type of insurance, but also actually diminishing the availability of this insurance, because too many claims actually means for insurers it's very difficult to be able to carry out the protection. So that's a negative impact that we're seeing already from climate change on the insurance sector. In addition to this, the insurance sector relies very heavily on reinsurance. So you insure your risk with an insurer who will then go and reinsure the risk with a reinsurer who will then reinsure as well. So you're mutualizing the risk between different entities. The issue is by claiming under the insurance policies, there's more claims under the reinsurance policies, so exactly the same is happening in the sense that the price of reinsurance is raising, the availability is lowering. So again, it's causing an issue at the level of the availability of these products. And I was talking just before about protection gap, which already existed in 2015. And this, this tendency is going towards more protection gap because of the fact that this insurance is becoming less and less available. So the idea really is to be able to mitigate climate change, to be able to also protect it better. So in addition to these risks which are faced by the insurers, they have a duty, and they're seen, and this is something that we saw in the Paris Agreement, as really having a role of protecting against risk. And so here what we're seeing is the EIOPA, so again the Insurance Supervisory Authority at EU level, is looking at certain measures to try and push insurers to be able to continue to offer the protection which policyholders need, but by taking measures where in certain circumstances we're pushing policyholders to also take measures themselves. We call them climate change adaptation measures. So what does this mean? So for example, if you want to have an insurance against flooding in your house, the insurance will cost a certain price. If you, as a policyholder, take certain measures to mitigate the impact that flooding would have, so for example, you're putting anti-flooding doors on your house, there could be a consequence of the insurer saying, okay, then you've taken specific measures, we will bring the price of your premium down. So it's actually an incentive to policyholders, to the general population, to take measures against the negative impact of climate change, but it's also an incentive to insurers to continue protecting policyholders against this risk. This is something which is only in discussion at the moment at the EU level, but I think it's quite an interesting step forward which is being taken. In addition to the role of insurers as being underwriters of risks, insurers actually are some of the largest institutional investors in the world. They invest the assets which are put into the policies into various types of investments, so funds, etc. And these are generally long-term investments. So they have a central role in financing the economy. And so here, the two consequences can stem from this role. First of all, they can redirect these investments into more sustainable investments. So, for example, investing more in energy, in decarbonization of their portfolio, etc. But in addition to this, they can actually enable retail investors who are taking out these insurance policies to invest in sustainable products, which maybe on their own they would not be able to invest in, but via their insurance policy, they can actually invest into more sustainable products. So that's also an interesting role of insurance in the sector. So the insurance sector is faced with the consequences of climate change, but they also have an opportunity as actors to be able to help protect policyholders, the general population, against these risks. And this is what was seen by the legislator when dealing with these types of questions. I'm not going to go into all the details, and as you see, there's a lot of acronyms in this sector, but it's really to show you that a lot of texts have been flourishing over the past years. A lot of them apply due to regulated status of certain entities, but others apply just due to the corporate nature of an entity. So if we start at the bottom, SFDR, so this is a disclosure regulation. This is really, I'll go into this in a bit more detail later on, but it's a text really aiming at pushing certain entities to disclose certain risks, how they're taking into account risks at entity level and at product level to make sure there's more transparency on the market. Then we have the taxonomy regulation, which really basically is giving a minimum standard of terms, of terminology, and just making sure that everyone's talking about the same thing. Then you have NFDR and CSDR, so these are really reporting directives, so the non-financial reporting directive and the corporate sustainability reporting directive. These are really texts which are looking at making sure corporate entities are reporting on specific sustainability topics, so climate change, biodiversity, and certain social issues. And finally, the CSDD, so the Corporate Sustainability Due Diligence Directive. Here, the idea is really making sure entities are identifying, preventing, and mitigating certain negative risks which can arise relating to human rights and environmental impact of the activities that they carry out by carrying out specific due diligence measures. So this is a general framework, and this applies to most corporate entities, to the exception of SFDR. When you're an insurance or reinsurance company or an insurance intermediary, you're a regulated entity. So on top of this, you have your standard regulations which apply. And they have actually been amended to take into account the sustainability risk. So I'm talking here, for example, about the Insurance Distribution Directive. So it's a directive which lays down the rules when distributing insurance products applicable to insurance companies, reinsurance companies, but also to intermediaries, so agents or brokers. Solvency II, so this contains all the rules on corporate governance, etc., applicable to insurance and reinsurance companies. And again, SFDR, which I'll come on into a bit more detail. So these are really, on top of all the standard ESG rules which are coming, we also see amendments to these rules to take into account sustainability. So as you can imagine, that's a lot to deal with for insurance and reinsurance companies. And it's really something which they're trying to comply with for the moment. So really the objective of all these texts, what is it? It's basically making sure that insurance, reinsurance companies, intermediaries are taking sustainability into account in all of their decision-making process. But also that they're asking their clients, what are your sustainability objectives? What do you want to do when you invest your funds? To also push the market to also itself push insurance companies to more sustainability. So today I decided to really focus on two main topics because, again, it could take ages. I'm just going to give you a very high-level overview of what we're looking at. First of all, jumping into SFDR. So SFDR is a text. It applies to two categories of entities, what we call financial market participants, financial market advisors. Financial market participants are manufacturing products. Financial market advisors are advising on products. In the insurance space, insurers are considered as financial market participants, whereas insurance intermediaries are financial market advisors. This only applies when dealing with certain specific life insurance contracts, which we call the EBIP, insurance-based investment products. which are really a product which has an investment nature. And basically, the main obligations of this text is to carry out specific disclosures. At the level of the entity itself, so the insurance reinsurance company has to disclose how they are taking into account sustainability in their operations, etc. But also at the level of the products which they are either manufacturing or distributing. The idea of this text is really to provide more transparency, but also encourage individuals, and this is what I was saying before, to invest into more ESG-friendly products. And so this is really the key text at the moment which insurance companies and reinsurance companies are trying to comply with. The difficulty that we have seen in practice with this text is that, as I was saying, it applies to financial market participants and financial market advisors. They have the same obligations relating generally to the same product, so they have to communicate. But the text itself does not provide for communication mechanisms, so there's a struggle in obtaining the right information. If you throw in there the fact that most of the underlying investments of these products are in investment funds who have the same obligations, and you have to obtain information from them coming up, it's a bit of a mess. So it's something which is quite complicated in practice to comply with. So in a nutshell, if we're looking at what we're talking about, the entity-level disclosures, there are two main types of disclosures which are applicable. The first is the relevant entity will have to disclose how sustainability risk is taken into account by the entity itself in its decision-making process, but also in its remuneration policy. On the other hand, it would also this information, will have to be included on the website of the relevant entity. So it's really quite public, and the objective is really to be transparent to push more sustainable decisions at the level of the entity. In addition to these, say, entity-level disclosures, you also have what we call the pre-contractual disclosures, which relate really more to the product. So how the sustainability risk is taken into account in a given product, in a given advice, which is provided by the relevant company. On the side, I explained that I just added the sustainability preferences under IDD because all of this will come together. I'll explain these quickly later on. But again, when we're looking at sustainability preferences, we're looking at the client's preferences in terms of sustainability. So all this information which is being provided by the insurance company, the insurance intermediary, is with the aim this information being used by clients to be able to make more conscious investment decisions when they buy a given insurance or reinsurance product. So when we're looking at products, and don't worry, I'm not going to start explaining all these categorizations, and I imagine you've heard them before, but because these products also fall within SFDR, they have to be subject to the categorization, the product categorization, which is provided for under this text. Basically, the idea is the greener the product, the better it is, and you have free categorizations of products to sort of be able to enable clients to know which type of clients they're investing in. As a basic principle, all products are Article 6 products. So they're products which either integrate a sustainability risk or they don't. That's the starting point. Then it gets a bit more complicated. You have what we call Article 8 products and then Article 9 products. Article 8 products will be a product which basically the objective is to promote environmental or social characteristics. So that's the general Article 8. Then the breakdown is you can promote the product, but not, you can promote these characteristics and not invest into these type of characteristics. In this case, it will be what we call a light green product. So you're promoting a social, environmental characteristic, but in the end of the day, there's no investment made in these types of products. On the other hand, you have what we call mid-green products, which are products which have this promotion of environmental and social characteristics, but actually a percentage of the investments of the products are actually made in these types of investments, we call sustainable investments. And so these are what we call mid-green products. The last category, which is the best category, let's say, are dark green products, which have the objective of, again, the objective behind it is covering sustainability aspects, but here basically the idea is all of the investments of this product must be into sustainable products. So you're looking at this, you can go, okay, it's easy. The one issue is this is quite a difficult process for professionals to be able to do this classification, especially when you're dealing with an insurance product which has multiple investment options which are underlying. The second point is what we see on the market and what the regulators are raising is at the moment we see more Article 8 products for various reasons, but one being the risk that professionals are wary of greenwashing. They're worried of saying, okay, this is an Article 9 product, when at the end of the day it's maybe not, because there's not enough practice on the market, there's not enough, it's quite a new text, so they haven't seen what's been going on. The other problem is, because of the fact that it's quite new, there's not also certainty that clients are still aware of the type of products. Because you have a lot of these Article 8 products, they may not be aware that there are greener products on the market. So for the moment, the transparency is maybe not working itself. But really, the idea is what I was saying before, is really to push for investment in more sustainable products. So we're talking more about the dark green products. And this is where the sustainability preferences of the clients will come into play. So this was SFDR in a very, very high-level nutshell. It's a very technical text with a lot of RTS, so I won't go into detail. But really, if you want to remember one thing from this text, is basically it's a disclosure regulation. The idea being really to put out there on the market information on how the entity itself is taking sustainability risk into consideration, and also providing pre-contractual disclosures on the products it's either manufacturing or distributing, the different, and categorizing these products by whether or not they're 8 or 9 products, which also change the disclosure. So really, that's the important message behind SFDR. Now next, as I was saying before, SFDR is a specific text. It doesn't just apply to the insurance sector. It applies to the fund sector, it applies to banks, it applies to a wide range of regulated entities. But here we look at specific texts, which they all existed before the sustainability rules came into play, but they have been amended to take into account these sustainability objectives. I really wanted to focus more on the IDD, so the Insurance Distribution Directive, which applies to, as I was saying, insurers when they distribute directly, which means they're not distributing using an insurance intermediary, or to insurance intermediaries themselves, so brokers, agents, etc. They lay down very clear rules that have to be taken into account when carrying out this distribution, one of them being to determine that the product is suitable to the client's profile. It's called a suitability assessment. This suitability assessment usually took into account the financial situation of the client, the knowledge of the client, etc., in relation to financial products. And this has been amended to make sure that basically the investors, so the policyholders to these insurance products, participate in the transition by making sure that their sustainability preferences are taken into account. So when carrying out this suitability assessment, now professionals will be required to ask clients, what is your sustainability preference? And the client will have to give this preference. Then the relevant insurance company or insurance intermediary will only be able to offer products which are in line with these sustainability preferences. So really the idea is also to have a push from the market towards insurers to offer more products. Because if you have insurance policyholders who are asking for sustainability products and there are none on offer, there will be a mismatch between offer and demand. So that's really the objective of this text. In practice, again, it's something which at the moment is a bit more nuanced. What we're hearing from the market is that not that many clients are asking for sustainability in their products, so it's maybe something that also is taking a bit of time to put into place. What comes with this sustainability aspect in the suitability assessment is a lot of pre-contractual information, again, on the insurer, who have to explain to the policyholder what sustainability preferences that mean, and offering different types of preferences and really making sure they understand it, which is, again, quite a tricky exercise when you look at the volume of the text and the complexity of these texts. Putting it into something which is quite simple and understandable in a document which is not 200 pages long is quite a challenge in the market today. So in addition to this, so this is IDD, really the sustainability preferences. Two last points I wanted to mention, which are actually linked, are what we call the product approval process. When an insurance company markets a product, creates a product and distributes it onto the market, they have to determine who they're going to distribute this product to. That's what we call the target market. And so this target market has the specific rules around how this can be determined, and now this target market also has to take into account sustainability preferences. So the idea is also to make sure that the products have been distributed through a market which makes sense. So if this market has requested specific sustainability preferences, the idea is for it to push insurers to produce more products which go to that type of market. The last point is risk management. So here we're looking at solvency, capital ratios, etc. But one particular point which is interesting is that insurance companies have to invest their assets following what we call the prudent person principle. And now this has been also amended to make sure that investments by insurance companies take into account the impact of their investment on sustainability. So they themselves and their own investments will also have to take this into account. So this comes on top of all the analysis they have to carry out for their clients. This will also have to be done for their own investments. So again, it was a very high-level overview of the obligations. A quick summary would be SFDR, again, as I was saying, it's a disclosure regulation. IDD, so the Insurance Distribution Directive, the idea is now to listen to what the client is looking for, the client's preferences, to push towards offering more sustainable products and having the client participate actively in this transition. And the Solvency II, again, the idea is to make sure that the insurance company redirect their capital flows towards more sustainable investments. So again, pushing them to take into account sustainability risk in their own investments. But a legal presentation is never complete without a few sanctions, because that's what we do. And the idea is really to create incentive in complying with these obligations. If you breach SFDR, so for example, there's a lack of disclosure, or the disclosure is not done correctly, it's done too late, etc., then you can be liable for a specific fine under SFDR, which is up to 250,000 euros. It's a regulator in Luxembourg, so the Insurance Commissariat aux Assurances, the insurance regulator who would be competent to impose a fine. In addition to the SFDR specific sanctions, you also have specific sanctions which apply to IDD and Solvency II, so if you're not taking the client's sustainability preference on board. Here, depending on the type of product you're distributing, so are we distributing an insurance-based investment product, or are we distributing a more standard product? The less risky ones, which are not the insurance distribution, the insurance-based investment products, there we're talking about, again, 250,000 euros. But if we're talking about an insurance-based investment product, an EBITP, this can go up to 5 million euros fine. So it's quite a big incentive to be able to comply with these rules. From a practical perspective, I have not yet seen any sanctions being imposed by the regulator, but again, we're in a learning curve. This has not been applicable for very long. So for the time being, I think there's more of a lenience at the level of the regulator. I would expect that this is something that will be looked at more closely in the next months or years. This was administrative fines. There's also a possibility, and again, this is more a thought on my side, is there a risk of civil liability? Under case law relating to anti-money laundering and MiFID, so these are rules which are relating to governance, there have been cases in Luxembourg where it's been found that a client can bring forward the liability of, it was a bank, I think, at the time, for their breach of those obligations which are applicable to them. You have to show that there was a fault, that there was a loss, a damage, and that this was linked together. It's a standard civil liability, but it was held in two cases. These IDD Solvency II rules, these are also similar, especially IDD, to MiFID. So there could be a possibility that if a case was brought forward to court saying, okay, this insurance company did not comply with IDD, so I suffered a loss because I was not able to invest in a certain product, etc., it could be that this could bring civil liability before court. Again, no case law on this, but I think it's just a quite interesting thought for the future. And lastly, this is not a financial sanction, but is there not a risk of sanctions by investors themselves? So if insurers, reinsurers, insurance intermediaries are not offering the right products, and if you have a demand on the market for more sustainable products, there may be a risk of these clients or potential clients looking at insurance or reinsurance companies that can offer these products, or actually even going to alternative types of products issued by banks, etc. So this is also something to take into account, and I think it's the objective of the text itself is really to make sure that if the demand is there, that the offer also matches at the level of the insurance companies. So I think there's a lot to do. There's many obligations. It's quite difficult in practice to implement. And I think really the objective is to make sure that these funds are going to more sustainable investments. It makes sense also for insurers because, as I was saying at the beginning of the presentations, they are actually the ones facing firsthand certain of the consequences of climate change. So they also have an incentive to be looking at these more sustainable investments. Of course, there's more to come. The regulatory space never stops moving, so we do expect additional changes. So, for example, just the text I was talking about earlier about the climate change adaptation measures. So I think we look forward to reading those probably very long texts which will come. But yeah, I think it's an interesting space to follow. I think we don't have time for questions, but you have my details here. If you want to give me a call or send me an email to discuss any point I've just raised, I'll be, of course, happy to answer anything. Thank you very much.
So thank you, Helena, for this insightful presentation, and thank you, Alan and Overy, for hosting this session.